I've been investing for over 10 years, and in that time, there's one strategy that has stood out among the rest. This is the same strategy that helped me grow my 401k from 19,000 to 152,000 in just 3 years. And it's the same strategy that I'm going to use to get that account to over $1 million. And the best part about this strategy is that you can just set it and forget it with a peace of mind that your net worth is growing even while you sleep. Of course, I'm talking about the 3 ETF portfolio, and in this video, I'm going to talk about the 3 kinds of ETFs that I would put in the portfolio, how much I would allocate to each type of ETF, and some common pitfalls that I think a lot of investors fall into that I want to make sure you avoid when you build your own 3 ETF portfolio. By the way, if you're new here, my name is Brian. I'm a former investment banker with a Master of Science in Finance, and my goal is to help you grow your net worth and invest with confidence. So the 3 ETFs that are going to go into this portfolio are a US-based stock market index fund, an international-based stock market index fund, and a US-based bond market index fund. And the reason we're picking these 3 funds is because we want diversified exposure across not just stocks and bonds, but also across US and international markets. In fact, it may surprise you to know that while the S&P 500 is up 15% just this year so far, the international index that we're going to put into this portfolio is up 28% over the same period. Obviously, there's no guarantee that every year is going to be like this, but it is one example that goes to show that if you are over allocated towards US equities, then you'd miss out on potential gains from international equities and vice versa. And there's a similar rationale for why we're also including bonds in this portfolio. While bonds have not performed that great over the last 1 or 3 or 5 years, it's important to remember that the stock market has been on a historic bull run over that time. But nobody knows how long this bull market will keep going, and many agree that at some point we will get a correction in the stock market. And when this happens, many investors are going to be glad that they had at least a little bit of their portfolio invested into fixed income. For each of these asset classes, there are many good ETFs to choose from. In fact, the S&P 500 has over 20 that you can choose. For the sake of simplicity, here are the 3 that I use in my own portfolio. For the S&P 500, I use SPY, which is the S&P 500 ETF with the longest history. For the international fund, I use ticker ACWX, which is offered by iShares and is an international equities index that has 0 overlap with the S&P 500. Lastly, for the bond ETF, I use ticker symbol AGG, which is also offered by iShares and is an ETF that tracks the total return of investment-grade corporate bonds here in the United States. Now, as I said, there are many alternatives to these ETFs. For example, there's a VOO for the S&P 500, there's IXUS for another international fund, there's also BND, which is a bond fund offered by Vanguard, but I've been using these 3 for a very long time. They've served me quite well, and the differences between these and the other alternatives are fairly marginal. So now that we have 3 ETFs to put into the portfolio, let's talk about how much we're going to put into each ETF, which is also called asset allocation. And this is my favorite part about investing because this is where you can really customize the portfolio based on your goals and situation. First, I'll tell you my allocation, and then I'll tell you how you can best customize this for you. I use a 60-40 split between stocks and bonds, and I've got that 60% of stocks divided equally between US stocks and international stocks. While this may be a little bit more bond allocation than the average investor might be comfortable with, I personally think the stock market is a bit on the overvalued side, and I want a little bit more protection in my portfolio, at least for the near term. On the other hand, maybe you think the stock market has a lot more room to run, and therefore you want more exposure to equities. So let's talk about how to customize this portfolio. And there are really 3 options that I think you should know about. The first one is what I like to call the Warren Buffett approach. He's been investing longer than most of us have been alive, and while he's made most of his fortune picking individual stocks, his advice is that for the majority of people, the majority of time, they should just invest 100% of their portfolios in stocks. I think this is a fine approach as long as you're willing to take on the potential volatility that comes with having 100% of your portfolio in stocks. For example, there have been multiple times in history where the stock market has fallen 30, 40, or even close to 50% in a short period of time. And while many people think that they can ride out that volatility without selling at the bottom, the reality is that it's easier said than done, and sometimes you may run into a situation where you're forced to liquidate some of your portfolio at the wrong time. That's why I think it might make more sense for some people to just take a simple quiz online to find out what your investment allocation should be. These quizzes are completely free to take. They're only about 10 or 11 questions and shouldn't take more than 5 minutes of your time, and they take into account a lot of your specific factors. For example, how experienced you are with investing and how long you are planning to invest for. Once you get to the end of the survey, you get a suggested asset allocation between stocks and bonds. For example, I just took the survey and I got an 80-20 split, which is a little bit different from my current split of 60-40. However, there's one more method that I like to use because it's very simple, and that is called the 100 minus rule. This is a simple rule where you take 100 minus your age, and this is the amount that you invest in stocks, and the other part of your portfolio goes into bonds. In my case, I'm 32 years old, so that would mean 32% of my portfolio should go into bonds and 68% of it should go into stocks. I like this approach because it's super simple and you can get to an asset allocation in a matter of seconds. However, I do think it has a few drawbacks. The biggest one is that as you get into your 40s, 50s, and 60s, you're allocating more and more of your portfolio into bonds, and I think a 60-40 portfolio is about as conservative as I would want to get even as I get older in age. And if I were to pick any of these one approaches over the others, I would probably go with the investing questionnaire because that one takes a very short amount of time and it takes a lot of your personal details into account. Now, before you go building your portfolio, let's quickly talk about some of the pitfalls that I see a lot of investors run into. The biggest one is fund overlap, which is when you have multiple investments in your portfolio that all hold the same stocks. This means that even if you feel like you're well diversified, you might actually have more exposure to specific companies or industries than you realized. Luckily, there's a very easy way to check this using a free website called etfrc.com. Once you're there, you can enter the ticker symbols of two ETFs, and the website will quickly show you how much overlap there is between the two, if any. For example, between SPY and ACWX, which were mentioned earlier in the video, there is zero overlap, so that you know when you're investing in these two ETFs, you are getting full diversification. However, if you were to combine something like VOO and SCHG, which I've seen mentioned around here on YouTube before, there is a lot of overlap between these funds. The other big pitfall that I see a lot of investors fall into is overthinking when they should get into the market. Right now, stocks are near all-time highs and have gone up on average around 25% per year for the last 3 years. And as a result, many investors are asking themselves, is now a good time to invest given that the market is at all-time highs? I decided to answer this by looking at almost 100 years of data going all the way back to 1928. And I decided to run a little experiment. I decided to look at the average 3-year return following a month where the stock market hit an all-time high compared to all other months going back to 1928. Now, you would be a very reasonable person for thinking that if you were investing at all-time highs, you would make less money than if you invested in other months, which would de facto be lower prices. But the data speaks for itself. When investing at an all-time high, the average 3-year return is 24.1%. Compare that to all other months that are not all-time highs, where the average return is 24.6%. That's a difference of 0.5% over a 3-year period. And it really gives a lot of weight to the old Peter Lynch quote that far more money has been lost waiting for a correction to happen than has been lost in the actual correction themselves. So if you are waiting to invest just because you think the market is at an all-time high, you might want to think again. Anyways, that covers the 3 ETF portfolio, the 3 that I use personally, how to approach determining your asset allocation between those 3 ETFs, and 2 major pitfalls that I want to make sure you avoid. Thanks for watching, and I'll see you in the next one.